Hey guys, Toby Mathis here, and today we're going to dive into a ton of different year-end tax planning strategies. So we're going to jump in. I'm going to call it a whole bunch of tax deductions in 15 minutes. So let's just put a clock on it and let's just jump in. Number one, you're a cash basis taxpayer as an individual, which means that you need to actually incur an expense if you're going to try to take a deduction before the end of the year. So there are things you need to do by 12/31. And there's certain things that you could do after the end of the year, like before you file your taxes, where you could still make contributions next year and lower your taxes for this year. So I'm going to break them into two categories: stuff you have to do before the end of the year, and then stuff you can do after the end of the year. Stuff you have to do before the end of the year. If you're going to do things like take a mortgage deduction, if you're actually itemizing your deductions, which means the total of your health expenses that exceed 7.5% of your adjusted gross income, your mortgage, your state and local taxes, and your charitable giving exceeds the standard deduction. I know I just gave you a bunch, but on your 1040, if you look at it, you're going to see a Schedule A, and you every year you decide, should I take the standard deduction, which is just under $14,000? I think it's 13,850 in 2023. If you're single, if you're married, you're closer to 28,000. Is it better to take the standard deduction, or do all those items add up to exceed that? And then I only get the amount that it exceeds it. That's really my only benefit. So when we look at things like your state income taxes, your property taxes, whatever medical expenses come out of your pocket, your mortgage interest, and then your charitable giving, if they're underneath that, you're not getting any tax benefit out of that, so you don't have to worry about it. If they're right on that line and just going above it, then what I'm going to say is maybe incur an expense that you would have normally waited. Like, let's say you do charitable giving, and every year you just, like, on a monthly basis, you're just one of those charitable people. And now it looks like you're going to be itemizing your deduction. Rather than make a payment in January, why don't you make it right now? Just get it done before the end of the year so that we can use it to offset our taxes. Then next year, use the standard deduction. We call it getting lumpy, right? Is you lump some different payments together. If you don't know where it's going to go, like, hey, I don't know who I would give the money to, I just know I give, then put it into a donor advised fund or something along those lines. And then rather than give cash, give appreciated assets. So if you have stock that's gone up this year, the S&P is what, up 20%. Look at it and say, hey, you know what? I'm going to give some shares. I get a fair market donation deduction. So let's say I bought a share of ABC for $100 and now it's worth $200. You get a $200 tax deduction without selling it by just donating the share to a charity, but you're going to have to jump on that. So that's kind of the basics for an individual. It's got to make sure those expenses are done. Now for businesses, if you are a S Corp owner or an LLC taxed as an S Corp, you got to make sure you do your payroll before the end of the year. Now, technically, you could potentially do this by January 15th, but I'd rather you get it done, get that check out. And the reason being is if you are going to contribute to your employee side of a 401k retirement plan, you need to do that before the end of the year. So if you have an S Corp, or if you're a sole proprietor and your tax as an LLC, you may still want to do this and make a late S election so we can eliminate a bunch of tax. Here's how it works. If I make $100,000 as a sole proprietor, I'm paying old age, disability, and survivors and Medicare on that entire amount. It's called self-employment taxes. So I would pay roughly $14,100. I think is what it actually amounts to. It's 15.3%, but part of it's deductible. So I would have to pay employment taxes on that entire amount. If I'm an S Corp and I take a reasonable salary, let's say a third, then I do not pay employment taxes on 2/3 of it. When I break it out like that, I only pay employment taxes on that portion that is considered to be the salary. So it makes a huge difference from a tax standpoint. And usually the numbers are at about 100 grand. You're probably saving close to $9,000 to $10,000. Like, it's not a small amount. It's a big chunk of money. It's 14% or whatever that difference is. Plus, you could do something called an accountable plan before the end of the year. If you have an S Corp, if you have a C Corp, if you have any of these, if you have a business entity and it's a year-end taxpayer. So like it's year-end. Its tax year-end is 12/31, like you and me. Now C corps can have different year-ends, but S corps always have a 12/31, or LLC's taxes S corps. You need to make sure that you're reimbursing expenses back to yourself. Like, for example, if I want to reimburse my cell phone, where's my cell phone? Reimburse my cell phone, the entire cost, all of the data, everything. I can reimburse 100%. Can't do this as a sole proprietor, but as an S corp or a C corp, you can. I will want to get that check written to me before the end of the year. I don't have to report it on my personal tax, because that's how accountable plans work. Is employee never has to say, hey, they reimbursed me for the donuts I brought in, or they reimbursed me for my office, or they reimbursed me for my cell phone. They reimbursed me for the computer I bought. The company takes that deduction, so you don't have to report it anywhere. So what ends up happening is the company lowers its taxable income, which affects you because it flows onto your return if it's an S corp, and you don't have to report it. So that's tax-free money. So you got to make sure you're doing that. Your cell phone, 280A, which is the Augusta rule. If you don't know what that is, start coming to our tax and AP events. Your administrative office for your home, your equipment reimbursements, even reimbursements for things like, hey, I had a holiday party and I had people over, or whatever. That's, by the way, holiday parties are 100% deductible. I know people think that entertainment's completely gone, but it's not. There's a holiday party meal. You can have a holiday party and it's 100% deductible. How about if you're going to make charitable gifts? Here's another one for you. This is non-business related, but I want to throw this out there. If you're one of those people, again, who donates money, but you're also taking a required minimum distribution out of an IRA, instead of taking the required minimum distribution, give the money that would have come to you, give it to a charity instead. It's called a direct donation from an IRA. And what it does is it takes the required minimum distribution off your tax return, period. You don't take a required minimum distribution plus a charitable donation. You can just directly donate that RMD directly out of your retirement account up to $100,000. And now you don't have to pay tax on it. It's just like it's gone. And that could affect your Social Security and the amount of deductibility. Things like that. Now, remember, mentioned entertainment deduction. Remember, they're gone. Since 2017, they've been gone. Can't write off entertainment. So if you're doing stuff like that, don't. Now, if you have a business, let's say that you're a real estate investor, you have a small business, you got your pizza shop, your plumbing company, whatever it is, realtor, whatever it is, and you have children, and those children are helping you in your business, you can pay them. I don't care if they're 9 years old. If they're helping you in your business, you can pay them. There's actually a court case on that. Now, if they're under 18 and you are a partnership or a sole proprietor, you don't have to even worry about doing any sort of employment taxes. If you're an S corp, C corp, that's the only time you get a little knock, because you're going to have to pay them through payroll. You're going to run either one of these. You have to run through W-2. But the kids, if they're under 18 and it's your, let's say that you have rental property and it's your partnership, you can pay them directly. And they do not have to pay any employment taxes. If they make less than $13,850, they don't have to file a tax return and they pay no tax. You, however, write it off on your tax return. That's why that's so important. But you have to make sure that you pay them before the end of the year, before 12/31. Make sure you pay them kids. Get it out of your tax bracket, get over there. Yes, you can do that with siblings. You can do that with your parents. You can do that with anybody that helps you in your business, and they have a lower tax bracket than you. Pay them so that they pay it instead of you. Now, I mentioned the 401k where I put the employee monies in. I can put up to $22,500 in an employee 401k, plus a catch-up provision, and then $7,500 if I'm over 50. That's the employee side. The employer side falls into the category where you can make that payment all the way up until you file that tax return for that employer, or for you if it's you, up until next year's tax due date, not the original due date, but plus extension. So the employer contribution, there's a 25% amount that the employer could contribute, or a defined benefit plan, or a SEP. These types of things can be done all the way up until that business files its tax return. So just know that some of this stuff is here. Something that I want to touch on is EV, electric vehicles, and solar. There's a 30% tax credit on solar, up to $7,500 on electric vehicles, you're going to want to just Google and see whether your car is qualifying, and then look at your adjusted gross income because there's a phase out. But those purchases need to be done before the end of the year. If you have a business and you're buying equipment and you're going to use a accelerated depreciation, or you're trying to write it off all this year, you're going to need to buy that piece of equipment and put it into service before the end of the year, which means I have to buy it and start to use it in that business by 12/31. If I get 1 day of use, I can accelerate that depreciation. I can use 168K, which is 80% accelerated depreciation in 2023, or I can use 179 if it's equipment, and that's 100% up to $2 million with the phase out afterwards. Talk to your accountant if you're wondering how to use any of this, or watch some of our videos because there's a lot in here. And by the way, if you're one of those people that says, I'm going to buy a car and write the whole thing off before the end of the year because my accountant told me to do it, stop. Like, it just rarely do I see somebody actually meet the criteria. Not only does it have to be equipment, and it's going to need to be something that we could deduct under Section 179, but it's got to be more than 50% business use. And you have to track your mileage forever on that puppy, like every trip. Nobody does that. Like, you can use Mile IQ, and sometimes it tracks it. Otherwise, just reimburse yourself the mileage. It was 65.5 cents a mile, and you could still use Mile IQ, and then you could just figure out which trips of yours are business. And even if it's for real estate and things like that, reimburse yourself your mileage. Jiminy Christmas. But don't fall for this whole, hey, buy the whole car and you can write the whole thing off, because you have personal use is always going to be taxable to you. Can't write the whole thing off if it's only being used 50% for business. And if it falls below 50% for business during its useful life or during the next 5 years, it's 100% taxable to you. They put it back on your return. They forgot to mention that part. Other things that you got to do before the end of the year is your IRA conversions. Let's say that you had a bad year, you just didn't make a lot of money, but your IRA is up and you want to convert it to a Roth. You got to do that before the end of the year. You do have RMDs in certain cases where you're going to have to make sure that's done before the end of the year. If you're prepaying things like your mortgage or something that you're going to put on your Schedule A, make sure that's done before the end of the year. And then let me just talk about unrealized stock loss and unrealized gain. If you are a married individual, I think you have up to about $90,000. I could actually look at it. You have a capital gain exclusion. It's going to be right around 90 grand, I believe. And the beautiful part about capital gains is if you have long-term capital gains and you're making like $50,000 and you're married, your tax rate zero on those gains. So if you have unrealized long-term capital gains, my recommendation to you is to sell it and buy it back and capture that gain. Go ahead and put it on your tax return, and you're going to look like you made, let's say you had an extra 10,000. So it's going to make it look like you made 60,000 this year, but it's non-taxable. So you just reset the basis. So if you sell it in the future, you don't have to pay tax on that gain ever again. So I like looking at people's unrealized gains towards the end of the year and their realized and unrealized gains and losses. And I match it up. Like, let's say I sold some stock at a gain and I have some unrealized losses. I might just say, hey, sell the loss. And so we don't have to pay tax on this. And then you say, well, what if I want to buy that stock back? There's a wash sale loss rule. I heard all about it. There's a workaround, right? Buy an in the money call to secure the loss. It'll attach to it, buy the company back, and then sell that call. And boom, you're out of it. But there's workarounds. Quit listening to all these crazy people who are like, oh, you can't do things. There's always a way. All right, now that's the end of the year stuff. Hey, I'm really looking at it 12/31. If you're paying charities, that's the big one. Make sure you've transferred assets or written the check. Otherwise, you can't write it off. Make sure you put money into your employee side of a 401k. Otherwise, you can't do it after the end of the year. The employer side, you can. Now, by April 15th, we got to have a couple things done. Number one, IRA contributions. You can put up to, I think it's $6,500 this year into a traditional IRA, write it off, or a Roth. You can still do that up till 12/15. But there's another triple threat out there. It's called a health savings account, and that is the big one. You can write off up to $3,850 as an individual. I think it's $7,750 if you're a family and you qualify as a high deductible plan, which you would just look at your plan doc and say, does it qualify for an HSA? They almost all do nowadays. And that is a deduction that I could make for 2023 all the way up until I file my or my tax return is due by 4/15. So I have until April 15th to put that money in. And now here's how it works. If I put money in an HSA, it's called a health savings account. I get a deduction, and any of the growth on it is tax-free. And if I'm using it for health expenses, it's tax-free when it comes out. So this is one of the most bizarre. It's better than a Roth. You pay it, you get a deduction, you pay no tax, and then when you remove it for health, you pay no tax. But here's the cool part. If I set up an HSA, even if I'm not using it right away, like I'm not doing any reimbursements, any expenses I have along the way, I can reimburse at any point in the future. So I could wait 10 years and then reimburse the stuff that I did in 2023. If you are somebody who has health expenses and you're trying to write your expenses off on Schedule A and you're dealing with the standard deduction and you never get to write it off, an HSA may be the trick, because I can write that off and then I could reimburse myself immediately. And now I have a deduction. It's not a Schedule A deduction anymore. It's an HSA deduction. And I can make that deduction all the way up until April 15th of the following year. So for 2023, we could be looking at making an HSA donation or, contribution into April. Let's say you did it April 1st. Fantastic. It's going to lower your taxable income. Now, I can't reimburse the stuff I did in 2023 yet because the plan wasn't in place. I can only reimburse things after I set that plan up. But I encourage just about everybody right now to set up that HSA. It's a fantastic tool. Now, things you could do even later than 4/15. Things I can do all the way up until some cases October of next year. I can make DB plan, defined benefit plan contributions, up until that company files its tax return. So if you're an S Corp, it might be, what would that be, September 15th. I can also, so defined benefit plans, by the way, are retirement plans on steroids. Instead of contributing a set amount, you figure out how much you would have to take out of it to keep making what you're making. So if you're making $100,000 a year, we reverse engineer it and we figure out how much you would have to have in your plan so that you continue to take $100,000 a year adjusted for inflation. So it's going to be a lot more when you retire. Well, that might be $2.5–3 million, right? And hey, how many years do I have to do that? Okay, you have 15 years to do that. Okay, I'm going to have to put $200,000 a year into the thing, right? That's how DB plans work. And we have clients that write off hundreds of thousands of dollars a year into defined benefit plans. They're called cash balance plans too. You can do that all the way up until you file the tax return. You can also do employer contributions to a 401k up until that employer files its taxes. So if you're one of those people that's always like, I never file late, I always file my S Corp on March. Okay, well, you're taking yourself out of the ability to do that extra deduction. Go ahead and prepare your return by March, file the extension, and just pay your taxes when they're owed. The return isn't actually due until September. And then you could decide whether you want a deduction for last year by making an extra contribution, right? And then the last thing is cost segregation. You hear me talk a lot about the best deductions for real estate. Cost seg's right up there. It's probably number one, is cost segging, bonus depreciation, become a real estate professional or do short-term rentals, create big losses, pay less tax. You can do a cost seg all the way up until you file your tax return, or the entity that owns the real estate files its tax return plus extensions. So you could be looking again at September of October of next year where you do that. But you probably want to start looking at it now and just say, okay, here's some things that I may want to look at. Last thing, and then I'll leave you guys alone to contemplate just a big bunch of tax deductions I threw at you, is if you exited real estate in this last year, 2023, and you didn't do a 1031 exchange and you're sitting there feeling miserable and you're wondering what are you going to do? Geez, Belize, this is where I get to tell you, hey, there's something called a lazy man's 1031 exchange where we just depreciate other assets, buy more real estate, accelerate the depreciation. It will offset even the gain, passive, believe it or not, that when you sell real estate, passive real estate, investment real estate, rental properties, et cetera, or syndications, it still keeps its nature as passive. So if you can create other passive losses from your other assets, do cost segregation, accelerate that depreciation, it can offset your tax there. There's also qualified opportunity funds that you might still be able to put money into, which is, I think those are a little bit of a red herring. But there's always a way, like if you have a taxable hit that you know is coming and you work with a good accountant, they may be able to give you some options. And in real estate, there's usually another option there for you, to give you some ideas. And then last thing is on that same real estate front, there's a safe harbor for $2,500 and below. If you have repair expenses, things like that, just make sure you're keeping track of your receipts, because it may be 6 months from now, somebody's looking at it going, can I write that off entirely, or do I have to add that to basis? The better organized you are, the better they're going to be able to do a job for you. So if you have expenses, if you did things at the end of the year, especially, make sure that they don't go above $2,500, because you have an automatic safe harbor of treating everything under $2,500 as an expense, as a repair, as opposed to a betterment, which just means I get to write it off now rather than spreading it out over 27 and a half years or 39 years. So keep track of that. If you do a loan where you have to provide financials, that amount actually doubles. So you have $5,000 per transaction. That's if you're keeping your financials for something other than tax purposes. So a loan qualifies. So if you have a portfolio loan or something like that, you might actually have a much larger repair bill. And then just work with a good accountant, please, who can actually help find you money. They're worth their weight in gold. And hopefully this video was worth its weight in gold in the last, I guess it's probably closer to 20 minutes. I would say 15, but I just threw a lot of deductions at you. Go back, listen to it again, share it with your friends. And if you have favorite deductions or things you think I missed, put it in the comments and let me know so I can catch it for next year. And if it qualifies, if it gets vetted out and works, then we can always look at seeing if we can't share it with other people. And at the end of the day, all we're trying to do is minimize the amount of tax that we're legally required to owe. We don't need to, we just pay our legal amounts. We don't need to give the government a tip. And besides, it's better to keep that money in your pocket so you can continue to make more money with it. It's better for everybody, including the government, if you do that. That's why there's so many incentives built in here. Just take advantage of them. Share this and like, and if you can, give me your comments. Thanks, guys.